So the syllabus, you have section A, B, C, D, E, F, and G. It's a very big syllabus. Yeah. Your section C of exams is usually from this part. And that is why this is your major part of the syllabus. Arguably, students always believe that this is the most difficult part of the syllabus. And this is on risk management. And I've gotten a lot of questions from a couple of students as well that want me to solve question on risk management. So today I'm going to solve a question on risk management. Likewise, I'm going to solve a question on section D, investment appraisal. Should do a question here. Working capital is also huge. We should do a question here. If we have time, so I'll start with this, maybe to this. Then if we have time on business finance, which is cost of capital, we can also solve a question there. Right. Yeah, but if you want to do any other way, just let me know as we move on. Yeah. Now, section A. Section A is a very short part, and all you need to know for exams in section A is the purpose of financial management. Yeah, and the purpose of financial management is to allow FM take three key decisions. And what are those three key decisions? You have the investment decision, the financing decision, and dividend policy. And why is this very important? Every company exists to make profit. From profit, that's where dividend is being paid. Yeah. Except you're a non-for-profit organization. Whereas in FM, we are not focusing on non-profit organization. We are focusing on profit-making organization, which is shareholders company that are expecting dividend or price appreciation of their shares. Okay, so but to make those investments, you need to be going for investment that will maximize profit. So you want investment that will maximize return. And to get that investment done, you need a capital. Where do you get the capital from? It's from financing. So when you get the capital, so you source for capital, you make the investment and you maximize return. When the return comes, you need to decide, how do you share that return? There are two policies you can use. There's a residual policy, and the other one is irrelevance sharing. Because I need to show you how the three decisions are linked together. What is residual policy? Residual policy is saying we're only going to pay dividend when we have exhausted all the available investment opportunities. And I repeat, residual policy is talking about you paying dividend only when you have exhausted all available investment opportunities, which means, take for instance, if you make profit of 50 million, you're going to check what are the investment options. You find 5 million investments, 10 million investment, 20 million investment, and you cannot find any investment opportunity that makes sense again. It means that you need to invest 35 million. And the residual amount left will be how much? That's 15. So it's 15 million you're going to share as dividend. That is what residual policy is talking about. Whereas irrelevance sharing does not care whether you pay dividend or not. They don't care. It's saying this theory is saying that shareholders don't care. They are not bothered. And you wonder, why are they not bothered? They are not bothered because for every shareholder, they believe there are two ways of making value, of creating wealth. Is it that they get their wealth creation from price appreciation of shares, or from the dividend? So if you like, pay the dividend, they will be happy. If you don't pay, they are still happy in as much as there is a price appreciation of shares. So it's either it's coming from dividend income or capital gains. This is capital gains from shares. So they can sell their shares and still make return from capital gains. And that is why this theory believes that shareholders don't care whether you pay dividend or not because they are alternative way of creating wealth for them. Those are the three key decisions that you must remember. This is very popular in section A of your paper, right? Likewise, stakeholders is very important in section A. Section A of the syllabus. You need to remember your stakeholders. Remember, there are three types of stakeholders. You have the internal stakeholders, you have the external, and you have the connected. The internals are the managers, the staff, everybody that is working within the organization. External, those are the guys that are not they are not involved in the day-to-day activity of the organization. Connected are the ones that are not directly inside the organization. However, they interact regularly with the organization. They are not internal, they are not staff, but they interact regularly. So if I give you examples, we said this will be staff and management. This will be like government, yeah, the public. But for connected, you're looking at things like customers, vendors, even shareholders. They are connected. They are not internal, they are not external. And that's why they are called connected. Okay. The biggest part of this is to understand that because there are different stakeholders, staff, government, customers, vendors, shareholders, they have interest. And that's why they are called stakeholders, because a stakeholder is anybody that has interest in an organization or the activity of the organization impact on that person, right? And that interest varies across the stakeholders. And because it varies, there will always be conflict. But your role as a finance manager is to manage this conflict. So you must know how to manage the conflict. And the popular conflict that you always must manage is the conflict between the directors or the management versus the shareholders. And let's look at their interest. These guys, they want a lot of bonuses, they want salaries, they want a lot of money to be paid to them. This guy wants a lot of dividends. And wanting dividend means they want profit, which means if you increase bonuses and salaries, what happens to profit? Profits will come down. And because of that, there's a conflict of interest. Because this guy wants a lot of bonuses and salaries, they can also manipulate accounts for their benefit, because they have access to information more than the shareholders. If you remember what we refer to as information asymmetry, because this guy has load of information because they're involved in day to day, but these guys, they have just little info in their disposal. And that conflict you must manage. And how do you manage it? That is what we call goal congruence. And how do you achieve goal congruence? Goal congruence means you are aligning the goals. You are making them look into the same direction. And for these guys, how you achieve goal congruence is to make sure that you are giving them share options. Then you are giving them performance related bonus or incentives, right? If you give them share options, like telling a director or a manager saying, yeah, if you are able to ensure that you deliver so share price increase, then you too you get some benefit. And what will be your benefit? You can say, I will give you 10 shares. Or if you work in this company for 20 years, you get 5 shares. If you work in company for 15 years and your performance is at certain percentage, maybe 80% performance, you get shares. Then the directors and management will start seeing themselves as potential shareholders. And that helps them to really start thinking like a shareholder, and with that, their goals are aligned. Yeah. Likewise, performance related bonuses, likewise, performance tied to share price. So you can say if share price can go up by 10%, you get 10% increase in bonus. So they start thinking like a shareholder, and they start thinking about the longer term of the business. That is the section A of the syllabus in summary. Let's look at B. B is looking at your environment, the economic environment. And the most important thing you need to understand is that every government has objective of achieving a steady economic growth. And to achieve this steady economic growth, inflation has to be put in control. Because if the government is not able to do this, then either the economy is eating up too much, or it's even going into recession. So you don't want too low inflation, you don't want too high inflation, but you want a steady inflation that is just optimal for the economy. And how does the government achieve this? They achieve this using two methods. Either they use what you call the fiscal policy, or what you call the monetary policy. This is called macroeconomic policy. When they are using fiscal policy, they are using taxes and government expenditure to manage inflation. When they are using monetary policy, they are using interest rates and FX currency rates to manage the inflation. And you must know how they use taxes and how they use expenditure to manage inflation. And how do they do that? When inflation is high, give you a quick revision on that. So let's assume inflation is high. And the way I'm going to tell you, for people that some people really get this confused. See, inflation has a lot of money in the industry, a lot of money in the economy, which is not good. So you want to take it away. So always see inflation as a lot of cash. That will help you. A lot of cash. See high inflation has a lot of cash, and see low inflation has very little cash available. Right. So too much money. Yeah, that's another way to see it. See, that's too much money. And you know why it's too much money? Because inflation usually comes when everybody is demanding for something. Inflation is rising price without value. Price is just going up, but it's not that the value is going up. It's the same thing. It's the same bottle of Coke, but the price keeps going up. It's just mere inflation. So you cannot allow that to go without being checked, right? So now let's say government wants to use fiscal policy. If there's too much money in the economy and they want to use taxes, definitely they need to government needs to find a way to take money out of people, and that is why they will have to increase tax rates to bring down the inflation. They must increase taxes such that this too much money that you guys are having, you start paying it to the government, and the money will leave the economy. And that will be vice versa if the inflation is low. And if they want to use expenditure, government expenditure, remember we're talking about government expenditure here. Look at government expenditure as when government is spending money to create infrastructure. they are building bridges, they are building hospitals, they are building schools, they are building industries, they are spending money to build all those infrastructures. When they want to build those infrastructures, they have to contact contractors, they have to employ people. By doing that, they are creating jobs. And by creating jobs, they will pay salary, which means they'll be pumping money into the economy because people will even be getting more money from government. And if inflation is high, that is not what a government wants to do. So in that case, to use expenditure, they need to reduce to reduce inflation, they have to reduce expenditure and vice versa. And likewise, for interest rates, if inflation is high, you have to make money expensive. Because if money is cheap and people can have access to money very easily, which happened during the COVID time when interest rate was super low. Everybody collected mortgage, loan, everything because interest was pretty low. However, by the time the government decides to open the economy, when vaccines came and all of that, rates started going up and they start mopping out those money that people have collected during COVID, start bringing in. Because inflation, when almost every part of the world suffered a very tremendous high inflation, 2021, 2022, because they were too lenient to peak economy after the COVID. The economic was extremely slow and low during the COVID because almost all the industry shut down, government shut down, countries shut down. But they brought down interest so low to kickstart the economy, but that even gave a super, super tremendous impact because inflation went just over the roof and they all had to start reducing it. You see what US has been doing. The US, Canada, UK, all of them increased their borrowing rate so high that now they just started bringing it down because they felt like it went super high. But they had to do that to really, really control inflation that we are seeing in 2022. Right. So if inflation is super high, too much money available, then you have to increase borrowing rate. Because when the rate goes up, then people cannot afford to collect more money, more loans, and even the ones they have to pay so much interest on it. And with that, the cash that is just too much will be reduced. Right. That's the biggest thing that you will need to know in section B. And we just move to section C quickly. Like I said, if you have any question, please feel free to stop me. Section C is on working capital. And the way I'm going to discuss this is I'm going to summarize section C of the syllabus, D and E all together quickly now. I'm going to take this CDE in this order. And I always like to do it using this formula, which if you have been following my videos, you probably have seen the way I've analyzed this formula. This is assets, which is almost like the company that you're looking at, the total asset of the company. We said this asset can be financed either with debt or equity. That is what this formula is talking about. And this asset is a combination of current assets and non-current assets. Likewise, this debt is a combination of current liability and non-current liability. Section C, which is your working capital, is focusing on current asset and current liability. That is what we want to talk about right now. And why do we need to manage working capital? Why? We need to manage working capital because there is always a conflict between liquidity and profitability. Please pay attention a lot to all of this because this theoretical part of this revision before we go into calculation will also help you with the theory of your exams. Your theory is almost 50% of your exam. So you can't pass FM without also understanding the theory. Calculation is just about 50%, if not even less. So your interpretation, your understanding will be tested in theory. So please pay attention, yeah, and ask questions if anything is not clear to you. Okay. So there's always a conflict between liquidity and profitability, and you can tell why. What is liquidity? Liquidity means too much cash. Yeah, you have a lot of cash. And high profitability means a lot of profit. If you have too much cash, it means that you are not investing, so you cannot make profit. That's what this means. So you no profit because you have not invested. If you have not invested, you cannot record profit. If you like, keep 1 billion in your house to 20, 50 years. It remains that amount. In fact, it will even lose value because of inflation. You can't make profit on it. Whereas if you decide to want to chase a lot of profit, then you have to invest in long-term assets because those are the assets that will give you a lot of profit. And when you do that, you don't have cash. And for a company needs reasonable amount of cash to settle obligation. Likewise, you need to be profitable to settle your shareholders. And that's why, as a finance manager, you must balance liquidity such that you have just enough cash to be able to take care of your obligation and profitability such that you're able to pay dividend to your shareholders. And that is why we do investment. We do working capital management. And for you to be able to do that, you need to understand the concept of cash operation cycle. Very important. And what is cash operation cycle? Cash operation cycle is the time, yeah, between your purchase of raw materials, and when you receive cash from sales to customers. That's a cash operation cycle. So, and in terms of formula, if they ask you in exams, after you do your definition, please always give the formula because sometimes, even if you make mistake a bit with your explanation, your formula can be your savior. Minus AP days, right? That is your cash operation cycle. And this is also called cash conversion cycle or working capital cycle. So if they ask you in any way, it's the same thing they're talking about. Right. So the lower, the better, because you want to have cash as quick as possible. So the lower the cash conversion cycle, the better for you. That's what you want to achieve. You want to minimize your cash conversion cycle as a company. That is your objective. Okay. So which means you need to know how to calculate AR days, which is your AR balance divided by credit sales multiplied by 365. And likewise, your AP days, AP balance over credit purchases or cost of sales multiplied by 365. And inventory days as an inventory balance over credit purchases as well multiplied by 365. All of this will give you your cash conversion cycle. Very important. The way question can be asked on this is how can you reduce cash conversion cycle? Remember, we said lower the CCC is the ultimate goal. Yeah, we want to lower CCC. Then the question can ask you how. So definitely we need to reduce this to reduce the total because it's this plus this minus this. We need to increase this and we need to also reduce this. However, in exam, the way you will answer it is you need to tell how to reduce the AR days, because the examiner knows that is implied in the formula. So what they want to understand is whether you really know how to reduce AR days. So how do you reduce AR days? You know it, but just that you got carried away to say, yeah, I've answered it and I move on. So please, in exams, don't always even leave the obvious. In as much as it looks obvious, don't leave it. You still need to say it. So how do we reduce AR days? There are several ways. So you can just mention reduce AR days by offering, maybe you can mention early settlement discount. You can mention prompt invoicing, factor, or whatever means. But one, at least mention one method. You can reduce inventory days by using JIT. Yes. You can even talk about maybe what other ways can we use to reduce our inventory? Maybe EOQ might help us. You can mention it. But obviously, JIT is the major one, because with JIT, you are tending towards zero inventory. And anytime your inventory balance is low, definitely your days will be low. If your AP balance is high, your AP days will be high. And if your AR balance is low, your AR days will be low, because this is directly proportional relationship, yeah, to the balances. Right. So increase AP days. How do you increase AP days? By negotiating longer payment days with your supplier. Okay, very important, yeah, to know that. So if they ask you how do you reduce CCC, then you need to tell them reduce AR days by early settlement discount, reduce inventory days using JIT, increase AP days by negotiating longer payment terms with supplier. Good. Now that is cash conversion cycle. What are the components of working cycle? Sorry, working capital. We have current asset and we said current liability. For current asset, this we are talking about cash, we're talking of inventory, and we're talking of account receivable. And for current liability, our focus is just on account payable. So when we're managing working capital, we need to learn how to manage cash, how to manage inventory, how to manage account receivable, and how to manage account payable. We must know how to manage all of that. Very, very important. Now, how do we manage each of them? Let's talk about cash first. No, let's start with AR. How do you manage AR? We've said it. You can use early settlement discount, which is when you tell your customer to pay early and get some discount. Yeah, and there's a calculation related questions on all of that. Early settlement discount, you can do prompt invoicing, because if you invoice on time, then the customer knows that they have to pay on time, because their days start counting immediately you invoice. If you don't invoice on time, their days will not start counting until invoicing. So, and I mean, the goods has left you. Yeah, prompt follow up as well on overdue account. You can use factor to collect faster. You can do invoice discounting. Yeah, all of this will help you with your account receivable. Yeah, and but for inventory, how do you manage it? Want to reduce your inventory balance? You can do bulk purchase discount. It can help you. You can do JIT. You can do EOQ. But look at this receivable and inventory. Why is it important to reduce them? It's important because we want to minimize the cost associated with them. And what is the cost associated with AR? Finance costs is number one. Because every time you have AR, it means you don't have the cash and you are using overdraft. to replace that cash. That is the simple interpretation. So finance cost, then admin cost, because you have AR department that are chasing those staff that will be chasing the customers to pay. Yeah, very important. Then if you have AR, there's a probability that you might not be able to collect all of them. Bad debt cost is also critical. This three cost is compulsory for every AR. Depending on how you manage it, then you can now have the likes of factor fee involved. Yeah. Likewise, inventory also has its own cost that we need to minimize. And you're talking of the purchase price itself. You talk of holding cost. You talk of ordering cost. Try to remember all of this. And likewise, you have the stock out cost. And a typical way of testing this, especially in section A, is the question might just ask you, if a company is using JIT, which of these costs do you expect to go up and which one do you expect to come down if you're using a JIT? Or they say if you're using bulk purchase discount, which of these costs will go up, which one will come down, or which of the following statement is correct? Then they will start playing around all these costs. So you know that definitely if you're using a bulk purchase, you will be buying at a discount. So purchase price will come down because the bulk purchase. Holding cost definitely will go up because you are buying so much. You need a big warehouse to store them, right? But ordering costs will have to drop because you will go to order less times because you are buying in bulk. If you need 12,000 in a year, you can buy that 12,000 at once and you won't have to incur ordering costs as if you're going to buy 12 times if you are buying 1,000, right? Then stock out will be very low because you're going to have so much inventory. But you can't say the same thing for JIT. For JIT, you are only buying when you need. Purchase price would most likely go up because you are desperate and the supplier will want to take advantage of you. Holding cost will be low because you are not keeping inventory. Ordering costs will go up because you have to order so many times as much as customers are placing order. Every order place is an ordering moment for you, so your ordering cost will be high. Then stock out risk will be high as well because the supplier might not be able to meet up when you have an order that is coming from a customer. Okay, that is it. And for EOQ tries to balance holding cost and ordering cost. And that is why at EOQ, your annual holding cost is always equals to your annual ordering cost. Yeah. And that's it for cash. So for inventory and account receivable. For cash, there are three ways that you are expected to know. There's Miller-Orr model, there's BOMO, and there's cash budgeting. The most popularly tested is the Miller-Orr. And what is Miller-Orr talking about? Miller-Orr believes that you will never have cash level that is constant like this. Your cash is always going up and down for any company. And for a company, you cannot work with the cash that is always going up and down. You need to be in control. And that's why Miller believes that you need to be able to set your minimum level as a company to say, we don't want our cash to ever go beyond this level. So you say this is minimum level. Likewise, because you don't want to keep too much cash, remember, if you keep too much cash, what happens to your profitability? Your profitability will be low if you keep too much cash, low profitability. At the same time, you don't want to have too little and you have problem paying your obligation. So, but because you want to create a maximum level as well, because anything more than this level, profitability is impacted. So you must establish your maximum level. Now, the other level that Miller now spoke about is, okay, you have maximum level, you have minimum level. So anytime we have something above maximum level, it means that we need to invest this cash. But how much do we need to invest? Should we just invest and come back to this maximum level? And the answer is no. Because if you always come back to maximum level, then it won't take you any time that you'll be out of maximum level. Same way, if you are under minimum level and you want to go back, should you go back to minimum level? The answer is no, because we only go back to minimum level. It doesn't take time, you go out again, and that will be so many activities going on for you. And that's why Miller also says then you have to define what you will call a return level, such that every time you go out of those minimum or maximum, you always have to return to your return level. So let's take, for instance, if you agree that your return level will be 50 as a company, your minimum level, you want it to be 20, and you said your maximum should never be more than 70. This is how you can be tested in exams. If your calculation shows maximum level is 95, then the question says, what must company A do? It means that company A must invest how much? Because you want to come back to return level, then you must invest 45. When you invest 45, you are back to return level of 50. If your cash goes to 5, then it means that you need to divest. How much? You need to go back to 50. So which means you need additional 45. So likewise, you need to divest 45, such that this takes you back to return level of 50. And likewise, this takes you to return level of 50. This is Miller All in summary, and it's not more than that. Yeah, but definitely you need to remember your calculation and all of that. Okay, that is summary of current asset management. For AP, like I said, it's pretty straightforward. It's just about negotiating longer term with your supplier. But at the same time, you don't want to take advantage of that too much that the supplier start thinking maybe you're having cash problems and you are losing some goodwill, and suppliers don't want to sell things to you again. So take note of that. The other part that I'm going to touch on is factors that determines the working capital level. Those factors are very important. Your risk appetite is very important, because if you are a management that has high risk appetite, which means you are a risk loving, it means you're going to be chasing profit. Yeah. If it's high, it means you are chasing profit. And in that case, you are set to have an aggressive approach. Aggressive approach because you are paying more attention to profitability than liquidity. And if you catch up with you, if this catches up with you, you might be going out of business. But you'll be able to make high profit anyway, but your liquidity is low. So, but if you are low appetite in terms of risk, then likewise your profit, you are not interested in high profit. So you are looking at low profit. And what does that mean? It means you are a conservative company. Yeah. And in that case, your current your working capital level will be low, very low, because we want to keep a lot of liquid assets. Yeah, but your profitability will also be, sorry, your working capital will be high because you are keeping a lot of working capital, very conservative. And high working capital means you have a low profit. But if you are aggressive, like you can see here, you're going to have low working capital because you have invested all of them in long-term assets because you are looking for profit. Another factor is the nature of the industry, very important. Nature of the business. Yeah. Obviously, restaurants will not have the same working capital as a manufacturing. Yeah. And likewise, service industries don't even have working capital that much. Right. So the nature of the business also very, very important. Yeah. And keeping this level of working capital can be driven by so many things. But there's a concept that is also very critical for you to remember, and that is over trading. And what is over trading? Over trading just means that you have high sales activity but there is no long-term fund to support the activity. So you are biting more than you can swallow. Yeah. So you will run into trouble if you continue into that. But how can you be tested for this? You'll be given a question and you'll be asked to say, check whether this company is overtrading. What do you need to do? You need to look for the symptoms of overtrading. And what are those symptoms? High percentage increase in sales. That's your first one. Remember from this. Very high. Low current ratio. So those are the things you'll be checking in your financial statement that has been given. Yeah, likewise, low quick ratio. Yeah. Another one you will see is that either the bank balance is reducing or is low. Yeah. Then you will see overdrafts, short-term funding going up. Likewise, AP will go up. Those short-term funding will go up. But what happens to long-term funding? Long-term loan will also either does not exist or is coming down. All of these are symptoms of overtrading. By the time you test 5 and it's pointing towards overtrading, then you can conclude that that company is overtrading. Yeah, so here either you are comparing with year on year or they will give you a benchmark company. Yeah, which you can compare with to say, okay, it's lower than this company, that means it's low, or it's higher than this company, that means high. So that's how you're going to be assessing that financial statement before you conclude that the company is overtrading. And what is the solution if the company is overtrading? There are always only two solutions. The first one is get long-term funding. Get long-term funding and reduce sale activities. And that is it with overtrading. I'm not sure there is anything left that we've not touched in working capital. Like I said, we'll go into questions after the whole syllabus. I want to spend the first 45 minutes here about to just go through the whole syllabus quickly. Yeah. Do you think there's anything we've left in working capital that you want to ask that we've not touched? Or even ABC, because we've done ABC now. If I go to D, which is on investment appraisal, any questions so far? Okay. Seems you're good. So for investment appraisal, why do you need to do investment appraisal? It's just for us to be able to choose investment that is good for the company. And how do we know the investment that is good for the company? We need to use methods. And the method of appraising is in two types. There's a discounting cash flow approach, and there's non-discounting approach. Yeah. So for non-discounting approach, you have things like payback period. You have accounting rate of return, which is also called ROCE. Yeah. You can also have for discounting, you have things like NPV, you have IRR, you have discounting payback method. Right? So sometimes when you have a question on investment appraisal, they give you the question and they ask you to calculate all of this. Then after, they will ask you to decide whether the company should take the investment based on all of this. So for each of these methods, you must know how to interpret it as to whether the company should take the investment or not. For all the non-discounting method, you need to compare with the benchmark for you to decide. That's how you know. So compare with the benchmark. So what we're saying is you cannot decide on their own whether they are good or bad until you compare to a benchmark. And your benchmark can be company policy. So the company will say, we only take investment with payback period of 3. So which means that any payback period of investment higher than that, such investment will not be taken. You can also compare with industry. Yeah. For you to know whether the result is good or bad. Okay. However, for this one, NPV, you take the investment and NPV is positive. If it is negative, you don't take it. IRR, you take it when IRR is greater than your WACC, which is the cost of capital. So for you not to get confused whether is it IRR that should be greater or is it WACC that should be greater, just think about it this way. IRR is a return and WACC is a cost. So for anything, return must be greater than cost. So think like that, because I've seen students that tell me, oh, they sometimes they just get confused whether it's IRR that should be greater or it's WACC that should be greater. Just remove that confusion right now. IRR is a return measurement, WACC is a cost measurement. Return should be greater than cost. And if that's the case, then you do the investment. Yeah. And for discounted payback period, you also need to compare with the benchmark, like the other non-discounted method. Yeah. So that's how you use this method to take decision. And we're going to solve a question on investment appraisal today. Most likely we'll have time to do that. Okay. Few things I'm going to touch on, which very critical on investment appraisal, is inflation. Because I know they usually use this to confuse you. Please, first of all, remember that inflation is just rise in price. So when they give you data, cash flows, and they tell you that these cash flows are in current terms, it means that those are real cash flows. Please take note. It means that those are real cash flows. So you need to understand the difference between real cash flows and money cash flows. Money cash flows is also called nominal cash flows, because sometimes in questions they don't call it money, they call it nominal cash flows. It's the same thing. So if they say real cash flows or they say current terms, that's what they are talking about. But why is this so important? It is important because when it's time for you to get your discounting factor, you must use, so this is the rule, you must use real WACC for real cash flow, and you must use money WACC for money cash flow. So it's money, real, real. You must not mix it. If you mix it, it's automatic zero. This is the rule that you need to know. And sometimes they give you money cash flows, they give you real cost of capital. Then you need to remember your Fisher's model. Fisher's model is the guide that will help you to convert money rates to real rates or real rates to money rates. And this is formula. It says that 1 plus money rate equals to 1 plus real rate multiplied by 1 plus inflation rate. So anytime you need to convert rates across money or real, you make use of this formula. It's going to help you. Okay. So that is the inflation part. They can also try to confuse you with sunk cost. Please know that sunk cost is not used in investment appraisal. We only focus on relevant cash flows. And how do you know relevant cash flows? These are the cash flows you will spend after you have decided to take the investment. So you must have decided after you have decided. It's not a cash flow that you spend, whether you decide or not. This one is only spent after you have decided. And that is why sometimes fixed costs that you expect to be a sunk cost will be a relevant cash flow. Because if that fixed cost will not be spent if you don't do the investment, then it's irrelevant. And that's why it's called, in that case, step up fixed cost or step up overhead. Because if we don't take the decision, we will not spend the money. But if we take the decision, we need to buy a building or we need to rent a building, then it becomes a relevant fixed cost. Okay, so very important. Another concept here, which is the working capital. Sometimes they introduce working capital. Two things. I'm
Sorry,
going.
before you, sorry for cutting. Before you go forward,
Yeah.
can I ask again that you differentiate between the money cash flow and real cash flow? I
Okay.
did not get this.
Okay. Very good. Good that you asked. So, money cash flow is that cash flow that has inflation. So, this includes inflation. Whereas real cash flow is without inflation. So, real cash flow that is without inflation is said to be in current times. So, take for instance, if you say today, if you want to buy a shoe today, you will buy it for $20. Today is $20. This is real cash flow because this is current times today. Remember, what are you buying? Just a pair of shoe. The same shoe in 3 years' time. The same shoe in 3 years' time. Same shoe. Would that same shoe cost $20? No, it will not cost you $20. It will cost more because there will have been inflation. So most likely in 3 years' time, the shoe might be $28. So which means in 3 years, the same shoe is $28, but today is $20. This is the money cash flow for that shoe because this has inflation impact for the future. Whereas the $20 today price is our real cash flow, which is our current times cash flow. So the same shoe of 3 years has a current value of $20 today, whereas in 3 years it's $28. But that is the major difference. So inflation is the difference. Money has inflation, real does not have inflation. I hope that clears, or you still want me to explain further?
Yeah, it's fine. I guess it's fine.
Fantastic. So that is why you can see that even the money rate that Fisher is giving us is showing us so that you don't have to even memorize that the money rate, one plus money rate, is one plus real rate multiplied by one plus inflation rate because it's real and inflation that becomes money. Okay, so another way they can try to confuse you is in working capital. So they sometimes they introduce working capital to your cash flows. And I see a lot of students getting rattled with this as well. And there are two things you need to note. Number one is to know how this impacts on your cash flow. And number two, which is very important, is to always remember to recover your working capital at the end, please. So every time they introduce working capital to your question, just see it as inventory. See it as raw materials that you need to start the project. Because at the end of the project, you will have to sell that inventory. You have to sell the raw materials. It's not going to sit down in your warehouse. You are done with the project. So always remember to recover that working capital. So a typical way is there are two ways. That is say beginning of the year, which is year one, there's a working capital requirement of 2 million. Because this is year one of investment. You are not going to require that working capital in December. It's what we would have been selling since January. So, which means always your working capital will be required in January, year one. And remember, the assumptions of your cash flow is that every cash flow you plot when you are doing investment appraisal is deemed to happen at the year end. So, a January year one cash flow will definitely be deemed to happen in year zero because that is December year zero, that is January year one. And that is why when you are plotting cash flow, this will be minus 2M in year 0. And if this investment has 4 years lifespan, at 4 years, which will be year 4, we must recover that 2 million back. That's one way. The other way is they tell you working capital requirement is maybe 10% of revenues for the 4 years. So year 1, year 2, year 3, and year 4. And you know that revenue is 10 million in year 1, 20 million in year 2, 45 million in year 3, say 80 million in year 4. And they say working capital is 10% of revenue. So if it's 10%, then that means we need 1 year, we need 2 year, we need 4.5 year, and we need 8 year. This is working capital requirement. However, this is not the cash flow that you plot. The cash flow you will plot will be this. Cash flow will now have year 0 impact because all these working capital requirement must happen beginning of these years. So which means for year 0, what we need beginning of year 1 must be purchased at the end of year 0. So this is minus 1 because we are buying. But let me introduce year 5 because I want to do something. So let me make this one 60. Yeah, so we need 6 here. Yeah. So which means year 0, we need to buy the one that we need in year 1 in year 0. So we already have 1. For year 1, the cash flow will be how much more do we need to buy to be ready for year 2? Because by January year 2, we must have 2. But we already have 1 in year 1. So which means we only need to buy 2 minus 1. So another minus 1 is what we're going to have in year 1 as cash flow. And the cash flow in year 2 will be what we need to buy in readiness for year 3. Year 3 needs 4.5. But at the end of year 2, we already have 2. So which means we need to buy 4.5 minus 2. And that's minus 2.5. Remember, outflow is minus. So it's 2.5. That's our cash flow there. Then in year 3, we need to buy what will make us to be ready for year 4. And for year 4, we need to begin year 4 with 8. And we're ending year 3 with 4.5. So we need to buy another 3.5. And for year 4, we need to be ready for year 5. In year 5, we need 6. But in year 4, we have 8. In that case, we don't need to buy more, but rather we need to sell part of what we have, and that will be plus 2. Because we are selling out of the 8 so that we can open year 5 with 6. And at the end of year 5, we're going to dispose the 6 that we have left. So that's plus. So this is your cash flow for working capital. And this is probably the tricky one that I know a lot of students struggle with. Right. So when you have working capital, please be careful, especially if it's a working capital that is annual. You need to focus only on the cash flow. And most importantly, remember to recover that cash flow at the end of the project. Any question? We're moving, and we're moving very fast. Okay, so that also looks good. The other one is taxation. And what I will tell you here is you must learn how to calculate depreciation or capital allowance, especially reducing balance. That's the most popular one they like to test. And likewise, watch out for taxes that are paid in advance or in arrears. Watch out. This is where they confuse you. For capital allowance, this is just you trying to get your tax benefits. So take, for instance, if you have asset that cost 100, 20% reducing balance, you just need to calculate cost, depreciation, then the allowance, the tax allowance you will get. So year 1, you are starting with 100, 20% of depreciation, that's 20. Yeah. Your allowance is, if tax is at 30%, The allowance is 30% of your depreciation. So you have 6. Yeah. The net book value at the end of year 1 is 80. Then you open with that again. 20% of 80, 16. Then you have 64. Sorry, 64 here. But your allowance will be 30% of 16. I think that's 4.8. Okay, and that's how you keep going. What do I want to bring out here? This is what you take to your cash flow projection, is your tax allowance. I've seen students taking depreciation to the cash forecast. That would be wrong as well. Because remember, you are only focusing on cash flows when you are dealing with investment appraiser. So it's very important to be comfortable with your depreciation. Like I said, reducing balance is very popular. If it is straight method, then that's pretty easy for you. But this reducing balance is very important, and that's how you go. And if I let me just try and finish this with you. So you open 64 again, and you do. Let's say this is for 4 years, so I can finish it quick. That's 64 again. So you do 64, still at 20%, and the position is 12.8. Then you get benefit at 0.3. Then you have 3.84. Then you close that with 51.2. Then your final year. Now pay attention to. Final year is very tricky because another place I know students struggle. Final year, this is year 2, this is year 3, this is year 4. You open final year with 51.2. You're going to charge depreciation at 20%, 10.24. And you have a benefit at 30%, that's 3.07. Then you close that year, net book value of 40.96. Now you can see year 4 has ended, but you still have net book value here. So which means at the end of the year, yes, you have year 1 benefit, year 2 benefit, year 3 allowance, but year 4, this is not the only figure you will have. This figure, then you need to do the final closing plus your final closing allowance. Your final closing allowance can either be a balancing charge or a balancing allowance. Yeah, charge is when you are paying, allowance when you are getting benefit. So you get a charge when you made a profit from disposal of the asset, or you have an allowance when you make loss from the disposal of the asset. And in this case, the net book value of the asset is 40.96. So it now depends on whether the question is giving you a residual value of huge figure that is more than this or less. But let's assume residual value is 0. So which means the asset is useful after 4 years, it's useless after the 4 years. In that case, you're selling for 0 of something that worth 40.96. So there's a loss of 40.96. And in that case, you are entitled to allowance. Because if it was a profit, you will pay tax. And when it's a loss, you deserve to get some benefit too. So at 30%, you get additional tax benefit, and that's called balancing allowance of 12.29. So which means when you are plotting your year 4 will be 3.07 plus 12.29. And that will give a total of 15.36 as tax benefit for year 4. So when you are plotting, year 1 is this, year 2 is this, year 3 is this, but year 4, you need to plot 15.36. Yeah. Those are the tricky things they try to put in the investment appraiser. And that is section D. Any questions as I move to section E? Okay, looks like we're still doing good. Very good. So for section E, it's about business finance, and that is about sources of capital. And I mentioned it on the other side when I said A equals to L plus A. These are your sources of finance. Either you are using debt or you are using equity or you are mixing them. So it's a combination of these two. This is someone's money and this is your money. But why will you use debt and not equity? Why will you use equity and not debt? Everything is determined by cost. Those are the because they might ask you what are the factors that will decide or determines the choice of capital. Cost is number one. Then number two is availability. Because even if it is cheap and it's not available to you, I'm sorry, you can't get it. Right? So cost is so big, and that is why it's actually the biggest part of this section. How to calculate cost of all this capital. So you have to know how to calculate cost of equity and likewise cost of debt. And for cost of equity, there are two models you can use. You can use dividend model or you can use your CAPM. CAPM is better than dividend model because CAPM considers systematic risk, which is the beta. Dividend model can be constant dividend model or growing dividend model. So remember all of that. Yeah. Okay. Then for debt, depends on the cost of debt, depends on the type of debt. If you have irredeemable debt, I remember I prepared a table for you guys then. Uh, if you watch this video on the channel, there's a table that I prepared, type of debt and the way you calculate the cost of the debt. Irredeemable is easy. It's just interest into 1 minus t over x interest price. If it's a loan, it's just interest into 1 minus t. It's a bank loan. Yeah. And if it is redeemable, the redeemable debt, then you have to calculate IRR. If it's a convertible, it's still IRR. However, after test of conversion, you must always do test of conversion. Very important. Yeah, and this is what we'll be putting into use when we're doing calculation. Extremely important to know. The type of debt determines how you will calculate the cost of capital. Yeah, and there are theories about how should WACC influence value of companies. Yeah, there are three theories you need to remember then, and remember that price of any company or value of any company is equals to the cash flow from that company divided by WACC. So naturally, what we are saying is that value of company is actually indirectly proportional to the WACC. So which means if WACC is high, value will be low. If value is high, WACC must be low. They don't go the same direction. They go in opposite direction. And now, the question is now, how do you manage your WACC? You want your value to be high. That is what you want to achieve because everybody wants the value of the company to be high. That's what we want, high value. But how do we achieve high value? By making WACC to be low. Then how do you achieve low WACC? Generally speaking, we say that cost of debt is lower than cost of equity. And why? Anybody can try. Why do we say this generally speaking that debt is cheaper? Why is debt cheaper? Any try? Who wants to try? Why do we always say debt is cheaper? Yes, go ahead.
there is tax shield on debt than equity.
Fantastic. Tax shield and debt. Thank you. Fantastic. One more. That is number one major reason. Very good. Any other one? There's one more from anyone. Yes, very good. Anyone. Okay, let me help you with the second reason. That was the very first reason, which is very important. Tax shield on debt, interest expense, actually. Remember, when you pay interest expense on debt, that is tax deductible, so you can get some tax savings. So there are some tax savings you make when you have debt, which you don't get on equity because, in fact, you still even pay more tax on dividend instead of saving money, right? Then, likewise, debt is more secured than equity, which means if it is more secured, it means it's less risky. Yeah, that means it's less risky. And why is that so? Because on liquidation, when you liquidate a company, the debt holders will be paid first before equity holders. So debt holders are ranked higher than equity holders. And because of that, debt is said to be less risky. And remember, the biggest principle in finance management is that the higher the risk, the higher the reward. So if you have debt that has low risk, you don't deserve high reward. That's why your cost or your reward will be cheap. Remember, cost and reward is the same. It's just from the perspective of who is giving and who is taking. If I give you money, I'll be talking about reward. And you that you collected the money, you'll be talking about the cost. Because my reward is your cost. The return I'm asking for is the cost to you because you are the one that will give me that return. Okay. So the higher the risk, the higher the reward. For people that have equity, the risk is high, and so they deserve higher reward. So generally speaking, that is the principle. However, some theories now came to discuss the impact of debt on work and equity on work and everything. And the first theory is the traditional theory. And what is traditional theory talking about? It's looking like, okay, this is cost of capital column. Yeah. And this is debt. So traditional theory is saying that if you continue to take debt, your cost of debt continues to stay like that. However, it gets to a point that your debt becomes so high, and the bank is saying we cannot continue to give you that same cost of debt because you are getting too risky. In that case, the bank will decide to raise their cost of debt for you so that they can collect more interest from you because you are becoming unstable because your gearing is becoming super high, right? The same guys looked at, okay, what will be the impact on cost of equity? Definitely because shareholders don't like debt. Because every time you collect debt, you pay interest before you pay dividend. And likewise, if there's by any means liquidation of the company, shareholders might not even be able to get anything from the company because everything will be used to settle the debt owed as well. So generally speaking, once a shareholder is seeing debt, they are becoming uncomfortable and they keep increasing their cost of equity so that they can get as much as they can get while you are still alive. But even get to that point where bank is increasing cost, the shareholders too, they want to astronomically increase their cost of equity. So this is your cost of equity line. This is your cost of debt. The question is, what happens to WACC? For traditional theory now believes that for WACC, since cost of debt is this low, cost of equity is here. Definitely, the more you take debt, the lower your WACC will get because debt is cheaper. However, when it gets to this point where the bank is getting uncomfortable, likewise, WACC will shoot up because you now have an increase in debt and also increase in equity. And this is your traditional theory. This is very important. You need to be able to differentiate between there are three theories. Now let's go to the second one. The two guys called M and M, Mondigliani and Miller, they now came with two theories. The first one is their stupid theories, so I call it, because they believe that there's no tax benefit on debt. So their first theory is no tax theory, which is really silly. They made additional assumptions, like they believe that market is perfect, which is not true. They believe that there is no transaction cost, which is not also true. Yeah. So there are no tax theory. They came and they said, okay, for them, they don't believe there is any tax benefit by taking debt. So they don't believe that taking so much debt will reduce your WACC. They don't believe that. So they believe cost of debt will be constant. They believe that WACC will be constant. The only thing they agree with is the fact that cost of equity will go up. So because they don't believe that there's a tax benefit, like we said here, that tax shield makes debt to be cheaper. They don't believe that. So they don't believe they don't see any benefit of taking debt on work. That is their no tax theory. But it didn't take them so long to wake up to their stupidity and say, no, there's a tax benefit. So they came up with another theory, which is M&M with tax. But you need to know the three theories. And what is the difference? Now, they woke up and they even woke up too much. They said debt, yes. They now ask you that you should keep taking debt. However, they don't agree that cost of debt will ever go up. So they said just keep taking debt. They still agree that yes, in as much as you are taking debt, cost of equity will keep going up. But now that they woke up too much and they said WACC will keep coming down and will keep coming down forever. So this is a theory that believes that you should maximize debt because they now believe that the more debt you take, the lower your WACC will be. Unlike traditional theory that believes that at the point, there will be a point whereby your WACC will start going up. Because in traditional theory, there is what you call the optimal point of debt, the optimal gearing, which is here. The optimal gearing is that point where your WACC is minimal. The debt level where your WACC is minimal. This is a point. And the whole of this side is so because there is what you call a substitution effect. And what's the substitution effect? The substitution effect is that the high cost of equity is being substituted by the low cost of debt. And on the other side here, this part, this side is what you call the financial risk effect. Because gearing has made all the costs to go up. Okay, so you can see that the three graphs are different and you need to understand them. You can be tested. Please pay attention to the differences and the similarities. Any question so far?
I have a question.
Please go ahead.
I struggle to understand the part of high cost of equity. The second, when you're trying to explain the advantages of debt over equity, you mentioned something about debt being less risky. I understand the tax sheet part, but you
Okay.
said debt is less risky. And then
Yeah.
in the different theorems, you're talking about high cost of equity. So I'm trying to understand where that high cost is coming from or what it means, because I cannot relate with the high cost of
Okay.
equity.
Fantastic. So the high cost of equity is coming from this same issue that we talked about here. Yeah, you are fine with the tax part, but because on liquidation, equity holders are the last set of people to be reckoned with. So if you want to shut down Apple today, the people that will first collect all the money from Apple will be the people that have borrowed money to Apple, that have lent money to Apple. All the people, all the banks that Apple is owing, those are the people that will be paid first. Elon Musk, all the other guys that has shareholding, whether it's Elon Musk, whether it's you and me that bought shares of Apple or whatever it is, we are the last person, and we might not even get anything back from our money if the money that was realized from all the assets of Apple was not enough to settle the debt holders. We don't even stand a chance, and that is why our money is at risk compared to the debt holders. So, because our money is at risk, anytime a company is going for a debt, shareholders are always uncomfortable. And how they respond to their uncomfortability, they demand for more dividend, they demand for more returns. And that is why when they are demanding for more returns for the company, the returns that the shareholder is asking for is the cost for the company. Remember, your cost of fund is a return for the provider of the fund. So if the shareholder is asking for more return because they're uncomfortable, then for the company, the cost of equity will be going up because they will be putting them under pressure to pay more dividend, to pay more returns, to find a way to make share price go up. And that is why the cost of equity is deemed to be going up. I don't know whether that helps you.
Let me just say what I've gotten, and then the other part I've not
Yes.
gotten. So I've gotten the part where you mentioned that before when liquidation happens, the debtors are paid first before
Good.
the shareholders, right? So that makes sense. So with this now, it would mean that um taking funds from, or what I understand now is taking additional loans or debts, right? It's riskier. That's what I get, given that, because more loans means that with liquidation, if there's liquidation, the focus will be on the debtors and less for the equity holders. So from there, I do not understand how we now say that debt is less risky.
Okay. Yeah. So remember, debt is less risky always because even when you take additional fund, you're not looking at the company. You are looking at the provider of the capital. When you're talking of whether it's risky or not risky. So what are the capital? Is debt and equity. So when I give you more debt, should I give you more debt or I should give you more equity? Giving See me as an investor now. You are the company. Giving you equity means I'm becoming a shareholder. But giving you more debt means I'm a debt holder. Which one will I give you if I don't want to take risk? I will give you debt because I know that you must always pay me back. It's an obligation. You must pay back. If I give you equity, there is no obligation for you to pay back. So that money is not guaranteed to come back to me. It's a chance. So at any day, at any time, debt will always have less risk than equity. Even the worst form of debt that is called mezzanine. mezzanine debt that is not collateralized, nothing. This is also called junk debt or junk bond. It's still is as worst as it is, still better than equity because there's still an obligation to pay this back, though it is ranked as the worst and lowest in amongst the debt holders. You will still pay these mezzanine holders before you consider the first shareholder. So when we are talking of risk, it's not from the perspective of the company that is taking the money. It's from the perspective of the people providing the capital, because we are the one that have something at stake. The company is just a shell. It doesn't have anything at stake. It just want to benefit. It just want to use fund. And at the point where the company is dying, there is no the company is not going to suffer. The two types of people that will suffer are the equity providers and the debt providers. But who will be taken care of? The interest of the debt holders will be taken care of first before the interest of the equity holders. And that is why equity holders are always unhappy seeing companies growing debt, because every time your debt increases as a company, you are reducing the chances of the equity holders being able to get back their capital because they are not guaranteed, because the company does not have obligation to pay them. And if the risk is going up, the reward must go up. And that is why debt interest will always be cheaper than what the shareholders will be asking for, because they want a lot before the company goes down. In fact, I've seen a company that their shareholders are telling them, whatever you make as profit, give us everything as dividend. We don't, because at this point you're able to pay your debtors interest and all of that. But whatever is left, pay us now. Because we know that if you keep this money in the business and anything happens in the future, this old money will be used to pay the debt and will not get anything back. So as much as you can get now, give us now. Does that help you?
Yes, it does. I get it. Thank you.
Fantastic. Yeah. Please, if anything is not clear, speak up. I can go as long as it's clear until you are very comfortable with it, because that's the essence of being here anyway. Okay, so those are the theories, and very important to note them. Yeah, another a bit complex part that I think students also struggle with is the assets and equity beta. Yeah, and why is this very important? We've said that work is very important in determining the cost of capital of any company. Remember, cost of capital is the cost of fund, and capital can be debt or can be equity. If a company has only equity, that means it has cost of equity as work. If it has only debt, then that means it has cost of debt as work. But if you have both, then you have work, because average of debt and equity is what you're using to get the work. So that's how you get your work. But to get your work, you need cost of equity. And what cost of equity do you need? The best cost of equity to use is the CAPM, which is this. Right. This is your market premium. This is your risk-free rate, and this is your beta. This beta that we're talking about here is the equity beta. Is equity beta. Now, is it all the time you have to use the company's beta? Or sometimes you have to use the project specific beta? Because anytime you are trying to calculate cost of equity, yeah, of probably you're planning to go into a new industry. You want you let's take for instance you are a bank You are HSBC Bank, but you want to go and do investment in real estate. That is not your industry. So you cannot use your company's beta to assess that kind of project. That would be wrong. Though there are exceptions to the rule, which I need to quickly mention to you. Three exceptions, I think. And number one is if the project is very small, yes, you can adopt the company's beta. Yeah. If the project is in same industry, then you can adopt the company's beta. Or if same pool of fund will be used to finance the project, then you can use the company's beta. If not, you must always use the project beta. And for you to use the project beta, then you need to get the equity beta of the project. But the problem is equity beta is a combination of two risks: the business risk and the financial risk. Whereas the asset beta is just the beta for the business risk. So this is not complete. This will only make sense if the company has no gearing, which means no debt. But you hardly find a company without debt. So financial risk is the debt, then the business risk is the risk that is inherent in the industry the company is playing. And how does this work? We said HSBC wants to go buy a property, real estate project. What this means is that the first one we said was to degear.
Yeah, we can see it.
Yeah. So you degear. When you degear, you get your asset beta. And step two is to gear back. And that gives you the equity beta. So you degear the industry rep that you have used, representative that you have used. Then you gear back with companies, your own companies gearing. And that's mean you're adding your financial risk to the asset beta that you have, and that gives you the equity beta. Yeah. And that is just the understanding you need to have. And the formula is only one formula you need to know that says that asset beta equals to volume of equity over volume of equity plus volume of debt into 1 minus t multiplied by equity beta. This is one formula you just need to use. To calculate equity beta is the same formula, you just need to rearrange it. Right. So don't get rattled with it. And that is it for section E. Then I move to F, which is business valuation. Business valuation is just, I say, it's just opposite of cost of capital. Yeah. Most importantly, you need to know those various methods, whether it's asset based, whether it's income based, or cash flows. Yeah. Just need to know all of that. There is not much to spend time on business valuation. Yeah. Usually all of them are rearranging your formulas. Take, for instance, if you remember your dividend model, when we're doing cost of equity, you say that cost of equity equals to D naught into 1 plus G over P naught plus G. This is price. In business valuation, this is what you are calculating. So in your business valuation, this is the same formula that will be rearranged into P naught equal then to be D naught into 1 plus G divided by KE minus G. I think it's this, yeah. Yeah. It's the same formula that was rearranged here. Because if you bring this here now, you have KE minus G equals to D naught into 1 plus G over P naught. This is the P naught you want to calculate. So take it here and bring this one here. And you have this formula. So it's the same formula you'll be using. Yeah. And likewise, if you are using PE ratio, this is where I need to give you a warning. If you are doing a valuation with PE, I'm just going to give you those little tricks that you need to watch out for. Please make sure you use the PE of the acquiring company to do your valuation. Acquiring company or benchmark. Don't ever use the same PE of the company you are trying to value to get the value of that company. Remember, PE ratio is equals to price over earnings per share, EPS. Price per share over price over earnings per share. Right. So this PE ratio should be for a benchmark, and that benchmark can be the person that is acquiring or the industries. Don't ever use the same company you are trying to value. This is a company you are trying to value, but you use the EPS of the company you are valuing. Yeah, which is your target. Please take note. Those are the little tricks you can see. Another trick I want to mention here is if you are asked to value bonds, yeah, please make sure you use pre-tax cash flow. Always use pre-tax cash flow because you don't use tax after tax cash flow for valuation. Investors can be any part of the world, different tax rates. Don't want to skew decision. Investors are required to make their own tax decision in their own jurisdiction. So in business valuation, we don't do post-tax because this might be confusing to you. In the cost of capital, we are always using post-tax, but in valuation, we always use pre-tax cash flow. Take note of that. The last part is on risk management, um, which is section G. Before I go into questions now, I'll give you a break, then we solve a question. Risk management. What risk are we focusing on? Good to note that there are different types of risk, but in this syllabus, we only focus on FX risk and interest rate. This is the biggest part. Yeah, this one you're only meant to know some theories, not calculation. So here you use swap to manage your interest rate, or you can also use FRA, right? But for FX risk, you can use either internal method or you can use external method. Internal method means the company is using its staff to do it. Yeah, they are not using the bank, they are not using derivatives. And what are the ways they can use it? Internal method to measure exposure. Remember, FX risk is that exposure you have, possibility of you losing money because the FX rate might go against you due to the transactions or balances that are dominated in foreign currency, right? So internal method, you can use matching, which means if you are exposed to dollar as a UK company in terms of asset, then get a liability as well in dollar so that you can match. You can match, you can invoice in local currency, which means you don't care. Even when I'm in the UK and I'm selling to someone in the US, I'm not going to invoice you in US dollars because you're in the US. I'm going to invoice in UK GBP. So you have to pay me my local currency. In that case, I'm not exposed. Or you can do lead payment. And lead payment means that whatever foreign currency you give me today, I convert it today. If you don't give me today, then I will just borrow somewhere and convert today so that when you pay me, I'll just give you back the money. Whatever you pay me, I use it to pay my debt straight away. So lead payment is immediate payment so that I avoid fluctuation. Yeah. And FX risk can be divided into three types. You have the transaction, you have the translation, and you have the economic. This is where we focus on so much because this is as a result of what you are buying or what you are selling. or your investment or borrowing. And you can see that there is a cash flow implication here. Here is due to financial reporting translation. So we are not focusing on it, but you need to know that it's due to financial reporting. Yeah, this is a financial reporting risk. When you are supposed to prepare your accounts every month, you do revaluation of foreign balances. Then you start having all those on end exchange rate income or on end FX income or all those ones. Those are translation. They are not cash flow items. We are not dealing with it. Economic risk is because you have a foreign based subsidiary. So you are exposed to the country risk of that country. Okay. Now, we've talked about internal method. External method is where we'll do some calculation. And this is where I'm going to start from when we come back from break. External method, usually you use derivatives with the banks. And here we'll be looking at things like forward transactions. We'll look at money market edge as well. So these are the two methods you use when you are dealing with external, using external method, where you are using the service of bank. And that's why it's called external. So I'm going to give you a break at this point, and in about 15 minutes we'll come back and we'll do, or let's maybe do 10 minutes. Maybe 15 minutes is a lot. Maybe 10 minutes, then we'll go into calculations. Let's see how much calculations we can do um before we end it. I think it's about 2 hours already now. I hope it's been worthwhile of your time. I've received a lot of questions on FR and that on financial risk, and that's why I honestly think it will be very helpful if we can touch on this. At least there are a lot of shortcuts, a lot of tips that I can give you for the FX risk, so such that you're gonna get comfortable with it. I know a lot of people don't like it at all, but it's not as difficult as it looks. It's actually pretty very easy. The only thing is you need to understand basic things. But if you don't understand those basics, then it looks like it's a monster. Look at this question. You have a company that is a dollar company. Yeah, it's dollar-based company. So which means this company is a dollar company and trades regularly in Europe. So it's exposed to Europe. Yeah, the company has recently bought goods. Yeah, and asked to pay 300,000 euro in 3 months' time. Yeah, 3 months' time. The exchange rate, they're giving us spot, they're giving us 3 months forward. Yeah. Now the question is, how you use forward contract? That is 26. How do you use late payment? Then 27 and money market. So this actually is covering all the three possibilities that you can be asked, right? Which is really good. So what I'm going to do first of all is to give you a bit of introduction to the quoting system, because that is where most students struggle. So know, should we be using buy rate? Should we be using spot rate? First of all, for forward, you know that a forward, it's a future agreement. Yeah. So a forward, it's a contract. Yeah. To either do a buy or sell at a price. Yeah. At a specific date in the future and a particular amount. Yeah. That's a forward. So which means you will not be using forward spot rates. You need to use a 3 months forward rate quote. However, we have a company, TPH, that's a dollar company. And the situation now is that it needs to pay euro of 300,000. And Because it's a dollar company, it doesn't have euro. So, which means he will have to buy this euro. The question is he going to be buying at 14545 or at 1545? Please pay attention to what I want to explain right now, because this is the solution to any confusion you might be having to choosing which rate. Two things you must always think about when you want to choose your rate. Please always think second currency, and please think bank. Remember, the company will be doing this transaction, this forward with the bank. So bank is the one that will always provide the quotes. Please interpret your quote based on the bank situation and based on the second currency. And second currency is always the currency at the back. The first currency is the one in front. So if the bank is selling second currency, then you are using selling rate. Selling rate. If the bank is buying second currency, then you're going to use the buy rate. Remember, the first one is usually the buy rate. So this is your buy rate. And the one at the back is your sell rate, because a bank will always sell more expensive than they are buying. Even you, anybody, anybody wants to sell higher than the price you are buying because you want to make a spread. Okay. So now, company wants to pay this amount in the future. And I've said don't interpret rate based on company, only interpret based on bank and second currency. And in this question, our second currency is dollar. Our second currency is dollar. So which means we need to interpret in dollars and not in euro. So if company wants to buy, so company wants to buy euro, it means that company will have to sell dollars. So we have moved to second currency. However, we need to interpret based on bank, not company. So if company is selling dollars, obviously they are selling dollars to the bank. And it means the bank must be buying dollars. Now, this is where you know how to pick your quote, because now you've been able to interpret based on the bank and second currency. So, which means you have to use the buy rate. So, when you have a quote, let's say you have this spot quote 1.4505 to 1.4545. This and this is saying euro slash dollars, right? So, because the quote has said euro slash dollars, your euro is the first one they wrote. So that automatically becomes your first currency. And the one at the back is automatically the second currency. When whatever you are doing in this financial risk chapter, whether it's interest parity, whether it's purchasing power parity, the currency they are writing first in the quote system, not in the narration, in the quote system, something slash something. Whatever they are putting first is your first currency. The one after the slash is your second currency. That's the first thing you need to learn. Then the first number, which is the lower number, is your buy rate. And the second number is your sell rate. And you always see that your sell rate will always be higher than your buy rate, because definitely the bank wants to make money. So the selling price must always be more than the cost price, because is it what they buy that is the cost price. And the difference is what you call the spread. Before I move on, are you happy? Are you clear to this point?
Yes.
Good. So you know the first currency, you know the second currency, you know the buy rate, you know the selling rate. Now, the question is, how do you choose which one to use when you are trying to manage FX exposure? And what I said is always think about two things. only think about the second currency and what is the bank doing on the second currency. So you think second currency, you think bank. In this question that we are looking at, what we know is that you cannot know straight away what the bank would do. First of all, you need to know what the company is doing. What we know the company is doing is that company will pay 300k euro, yeah, in future. And if they are going to pay 300k in euro, we know that this company is a dollar company. So which means they don't have the euro. And they are going to pay it. Then they have to buy euro. So company will have to buy euro. So company must buy euro. You know that. However, that does not help us yet because we want to talk about second currency, which is dollars. And we want to know what bank is doing it, whether bank is buying it or bank is selling it. The only thing we know that is company is buying euro. But we know that if company is buying euro, then we know that then the company must be selling the other currency. So which means company must sell dollars. Now we are in the second currency that we want. However, we need to know what the bank is doing, not the company. And if company is selling dollar, they are selling to the bank. And in that case, bank must be buying the dollar. So if bank is buying the dollar, then we are looking at buying rate. And because now we are looking at forward, the forward transaction that we are talking about. In that case, we should be looking at the forward quotes because this question says forward contract. So if it's forward contract, then we should be looking at forward quotes. And the forward quote is 1.4480 to 1.4525 euros slash dollars. But we are using buy rate. It means this is the rate that we will use because this is the buy rate. The first one is usually the buy rate. So that's what we have to use. And if that's what we have to use, then it means that 1.4480 euro, yeah, is equivalent to $1. Remember, it's per dollar. And we are looking for how much dollar the company needs to buy. So we'll cross multiply. So that's 300 times 1 divided by 1.4480. And that gives us the dollar equivalent. This is euro. Yeah. So what would that be? 300 divided by 1.448. And imagine, and this is actually the real answer. Before I go to lead payment, let me do it assuming that it's a receipt. Now, that is a payment. Let's say this 300 euro is a receipt, which means receipt in 3 months. So company is going to receive euro, which means they don't need to keep that euro because euro is a foreign currency to them. So which means company will sell the euro. That's what they want to do. Company want to sell the euro. If company is going to sell euro, we have said think second currency, think bank. Yeah. So which means we need to know what is happening to dollar and what is bank doing to dollar. So if company is selling euro, it means that company will buy dollars. And they must be buying from the bank, and means bank is selling the dollars. In that case, we need to use the sell code, which is this part. So, and that means 1.4525 euro is equal to $1. Then when the company receives 200k euro, how much dollar would they be able to convert it to? They will sell it to the bank and they will get this amount. So 300 divided by 1.4525. And that's 206540. And you can see that these examiners are so crazy. That is even here. If you have done it as a receipt instead of payment, you still see your answer there. It's crazy. And I hope forward is clear like that. Forward is this easy. All you need to do is to never make mistake with your code system. And that's why I spend time. Don't be in a rush to just figure it out. Go through this thought process. What is the bank doing to the second currency? Think second currency, think bank before you pick your quote. Because once you are able to do that, financial risk management is super easy because you will never miss it. You will, and mostly it's tested in section B. Mostly, most times. Yeah. And even if they bring it in part of section C, you don't want to miss it because it's just check marks for you. Any question on the forward? I've done both receipt and payment.
Hello?
Yes, go ahead, please.
Oh, goody. I have a problem deciding when to multiply and when to divide. I think multiplying is when I have to pay, and dividing is the other way, but then it always gets so confused and nervous.
Okay, fantastic. So what I would tell you is don't ever memorize that you divide or multiply when you are paying. Don't ever do that. What you should always do is this. Once you know your quotes, once you know the code, take for instance, you see in this one, we already know that the code that we are using for the question we solved there is the buying code, right? This 1.448, right? And this is the code 1.448 euros slash dollars. That's what they've given us, which means this code means that 1.4480 euro is equals to $1 because dollar is at the back, it's per dollar. What we're saying is like saying $2, sorry, like saying two, let me use one example for you. Take, for instance, you want to share 20 pen with 5 students. The ratio is 20 over 5, and that equals to 4. So what we are saying is that it's 4 pens per student. So this is a quote. So what we are saying is that 4 pens goes to 1 student. Now, once you write this first one, that is it. The next question is now, what do you want to do in terms of, do you want to work from pens to student or student to pens? So let's play with it. If I say, how many students will you give 16 pens to? What will you do? You cross multiply to this. You always cross. So it means 16 times 1. Then the other one that doesn't have a pattern that you are calculating comes down, divided by 4. And that equals to 4. So which means 16 pens will be equivalent to 4 students because this side is for students, this side is for pens. But at the same time, knowing the code that 4 pens goes to 1 student. If what I'm asking you to do is to tell me how many pens do I need to give 5 students, then I'll put 5 students here because students on one side, pens on one side. Then you cross multiply again, which is 4 times 5 divided by 1. And that means 20. So that means I need 20 pens for 5 students. So always do it this way. Don't memorize anything to say, when do I divide? When do I multiply? Most times, your life is super easy once you can just work it out like this. Just put out the codes and see it as what we've done. The same way. We said we know the code already. We know that the code is 1 point. When we decide, immediately we know the code that is 1.448. We're going to use this one. And this is the currency. So next is just say, so that means 1.4480 euro is equivalent to $1. Then the money we have is 300,000 euro. So it has to be on this side. So this euro side, 300k euro. Then want to know what is the equivalent of dollars here. Then we need to cross, we always have to cross. So 300 times 1, then the other one comes down, 1.448. And that's how we got 207,182. Because if you memorize that when I'm buying, I'm selling, I'm dividing, or when I'm selling, no, you will be confused. You must never memorize everything. It has to be intuitive, just like that. I don't know whether this helped you, but you're still confused.
This helps me a lot. Thank you very much.
You're welcome. Very good.
Mhm.
Okay, so I want to go to lead payment, but before I go, any other question from anyone? Lead payment is 27. Like I said, lead payment is about now. Remember, forward is about future, but lead payment is about now, which means you want to eliminate FX risk now. That's what you want to do. You want to eliminate that FX risk now. Like now, you don't want to delay it. You don't want to keep it for the future. And how do you do that? Look at this question. This guy has no surplus cash and he has to pay 300,000 in the 300,000 euro in the future. That's a big challenge for him. He doesn't have money now and he has a liability in the future and he wants to eliminate that foreign exchange risk now before 3 months' time. Then what does he need to do? Then he must borrow. But the question is he going to borrow local currency or foreign currency? He has a foreign liability, which is 300 euro. If he goes to borrow another foreign currency, then he's keeping two foreign currency loan. Then he has not eliminated anything. So this is bullshit. He cannot borrow foreign currency. He has to borrow local currency to take care of that. And that is why the question is asking now, what is the net payment in dollars? Because now it's going to borrow dollars and it's going to pay interest on that dollars. So he needs to borrow today, and he's still going to pay interest on that whatever amount he has borrowed to be able to settle the payment. So what lead payment is saying is that though this payment is due in 3 months' time, but I want to pay it now. I don't want to delay. I don't want to wait. I just want to pay it. I want to do it now. That's what he's saying. And when we get to money market edge, you will see an improvement on lead payment because money market improved on lead payment, make it to make more sense, and you will see it. And at the same time, you're minimizing cost when you use money market edge. But lead payment, it doesn't care. Just eradicate everything now. And what does it mean? You're going to pay. So company will pay 300k euro in the future in 3 months. But you want to use lead payment. It means that you want to pay it now. That's what you're saying. And to pay now is not anything different from forward. The only difference is now that instead of using the 3 month forward, we're going to be using the spot rate. And in that case, the same thought process, company will have to buy euro, yeah, because they want to pay it now. And it means bank will be selling the euro to them. And if bank is selling euro, then bank must be buying dollars. But bank will collect dollars to give them euro. Then we have thought of bank, we've thought of second currency. So, which is what we want. And in that case, buy rate of 1.4505. becomes our rate. And that euro is equivalent to $1. And the 300K euro is what we're looking for. And in dollars, it means we need to borrow cross multiply. So that's 300K times 1 and divided by 1.4505. So this is the dollar amount that we have to borrow today. And that's 206,825. So we have to borrow this amount today. And once we borrow this amount today, yes, we can convert it. And because bank is going to buy it from us and they will give us euro of 300,000 euro. Then we can pay it off, like I said, now. We want to eliminate it now. However, it does not end here because we have borrowed this money. We're going to pay interest on it. So that's why we come to this part of the question. We need to know what is the borrowing rate in dollars. Deposit rates per annum are 2% in Europe. Deposit rate is same as investment and 3% in home country, which is dollar. While the borrowing rates are 4% in Europe and 6% in home country. So the borrowing rate is what we need, and in dollar, which is the home country, is 6%. Please pay attention, you can see 6% is the borrowing rate. So we borrowed money and we'll be paying our 6%. 6% is annual rate. However, this transaction is for 3 months. Yeah, so which means 3 months rate will be equals to 6% divided by 12 times 3, and that's 1.5%. So which means our interest expense. So interest expense will be equals to 1.5% of the amount we borrowed. And that will be equals to 3,002. So the total, which is what they're asking, total net payment for us will now be 206,825 plus 3,102. That will give us 209,928. So this is the total money, and that is there. And that's lead payment. So sometimes the question might not ask for net payment. They might say, how much does the company have to borrow now? Then this will be the answer. That is why you have to understand, right? Because if the question had said, how much do they have to borrow now to make the lead payment? Then you have to stop at 206. But if the question is asking for a net payment in 3 months' time, then you have to consider plus the interest. And I hope that is clear. Before we go to the last question, which is on money market. So I'll use the last.
Sorry, before we go, I want to be clear.
Okay.
So are we assuming that because there's a lead payment, it means automatically means that the company has to borrow
No,
to pay it?
the company has to borrow to pay because the question says there is no surplus cash. So if they have said there is a surplus cash, then they don't have to borrow. They will just use part of their money. In that case, there won't be interest because they don't borrow. Then this would have been the total payment, even in 3 months' time. It's still 206. But if you don't have surplus cash now and you want to use lead payment, you have to pay now. Then the only way is to go and borrow.
You want borrow?
Yeah.
So they will always tell us whether there's surplus cash or not.
Yes, they will always. But most times they will tell you that there is no surplus cash. Most times. Hardly would they tell you that there is a surplus cash. In fact, I can tell you that I've only seen a question once in my entire life that has a surplus cash. So most times they want you to think further, because when you say there is surplus cash, it's easier to get the answer correctly, because whether you know you have to do more work or not, you will get the answer, because you can stop here and you still get the answer. But when they say there is no surplus cash, then it takes a student that understand the concept to know that you still need to compute interest expense.
Yes, I get you. Thank you.
Welcome. Okay, now lastly, on money market edge. This one is the most difficult amongst all of them. Yeah. But if you pay attention to it, it will make sense because I'm going to simplify it to you. And I'll give you that process that you need to be using. Use it to practice and you'll be fine. The first thing when you want to use a money market edge is to know what is the objective of the company. Oh, let's not go to objective first. Situation of the company before we go to objective. And what do I mean here? Does the company have asset or liability with this transaction? Obviously, what they have to pay 300K in the future. So what they have is account payable. And that's the liability. That is a liability. So if this is the situation, whenever you are using a money market edge, your money market edge objective is to create the opposite. So you want to create the opposite. And what do I mean? Here, the situation is that this company has payable of 300,000 euro in 3 months. Then your money market objective must be to create the opposite, which means create an asset that will be equals to 300,000 K in 3 months. That is your objective. The question is, how do you do this? Because if you're able to do this, then this will net this off, and you have been able to use money market edge to cancel any foreign currency exposure. Remember, like I told you, money market edge is an improvement over lead payment. Because with money market edge, you are using lead payment and you are doing investing and borrowing. You are combining all of that together. That is money market edge. Okay, that's your money market edge. However, when you look at lead payment, borrowed 206 and still paying additional interest on it. And you see the way this is slightly different from money market edge. Now, we know our situation number one. Our objective we know now. We want to create opposite transaction. The question is, how do we get this euro? Because we need the euro. We need the euro that will give us this asset. Because we need to invest that euro today, such that when we invest it today, we get interest income on it, and in 3 months' time, it will be 300,000. So, which means today we need to ask ourselves, how much euro should we invest? So, how much euro should we invest today? To invest today to give 300 euro, 300,000 euro in 3 months. That's the first thing. Because you're always going to work backward. Now, for us to be able to do that, we need to know what is the interest rate in euro, because that's how we're going to earn. So, interest rate in euro, they've given us, it said the deposit rate per annum. Remember, the interest rate, investment interest rate is deposit. It's the same thing like I told you. Yeah, and it's 2% in euro and 3% in home country. So, which means we're going to be using 2%. And remember, percentages are per annum. And here we're talking of 3 months transaction. And in that case, that would be 2% over 12 times 3. And that's 0.5%. So these are investment rates. So principal plus interest must be equals to 300,000 K in 3 months' time. That's what we're saying. And we want to know what should be our principal, because that is what we need today. That is the principal that we need today. So how do we get this principal? The simple formula you can use, I can derive it for you now, but let me just show you if you can get it straight away. Just use this formula. It's always principal that you need today is equals to the future value divided by 1 plus R. That's what you need today. And how did I derive this formula? Look at it. It's from this simple calculation that you're seeing. I'm sure you can relate with this. And look at it. Let me derive it for you again. Principal plus interest is equals to 300, yeah? Now, that principal plus, how do I get interest? Interest amount is interest rates, which is R, times principal that I'm talking about. That's what will give me the total future value. This is future value that I'm talking about. So if I invest P today, I make interest on it, then I get the future value. So which means my P plus rates and principal is equals to my future value. So if I substitute that, P into 1 plus R equals to future value. So the principal I need to invest today is equals to future value divided by 1 plus my investment rate. And that is the formula you have here. For any of you that likes mathematics, right? Like I say, I don't like people memorizing anything. You need to know where our formulas are come about, right? So which means if I need 300,000 in future and the investment rate is 0.5%, then I need to invest this amount, and that amount will give me 300 divided by 1.005 as 300, okay, divided by 1.005. Yeah, let's see what that is. 100 divided by 1.5, and that gives 298.507 euro. So what we're saying now is that if we invest this euro today, we're going to earn interest over 3 months, that after 3 months, this will become 300,000. So this is the euro that we need today. Yeah. But remember, this question is asking us, what is the net payment in dollars? Because that's our own local currency. That's what we need to settle this. So if I need this euro today, how do I get it as a company? The only way to get it as a company, is to buy it. So I need to buy euro. But the euro that I need to buy is this 298. So I need to buy this 298,507 today. But remember, no surplus cash. And what does that tell you? I have to borrow. Am I going to borrow foreign currency or local currency? I have a liability to settle in the future that is already foreign currency. I can't pay in the future. So I cannot be borrowing another foreign currency for sure. So I need to borrow local currency. So I'm going to borrow dollar and I will get this figure. So I need dollar that can buy this amount of euro for me. So which means I'm going to borrow dollar. So the company will sell the dollars. So borrow the dollars. Company will sell the dollars. If company is selling dollar, then bank must be buying dollars. So I'm thinking bank, I'm thinking second currency. Remember, dollar is our second currency. So once I'm able to think like that, where's the quotes? Yeah. Yeah. So And in this case, it has to be spot because I'm doing it now. So bank buys dollars at 1.4505. So this euro is equivalent to $1. And I'm interested in 298,507. And that's 298,507 times 1. I'm not charging my iPad. It won't go off, but we're almost done. Divided by 1.4505. In that case, I know the dollar amount I must borrow. That's that divided by 1.4505. So I have to borrow 205,796 dollars. So if I borrow 205,796 dollars today, I can sell these dollars. Yeah. By selling these dollars, I'm going to be buying this 298,507. And by the time I invest 298,507, I'll have 300k euro to settle my future euro liability. But does it end there? It doesn't end there because I'm going to borrow this. And when you borrow money, it's not for free. So there's interest expense. So, like I said, it depends on how question is being asked. And that's why I want you to understand. This question is asking for the net payment. So, which means you must consider everything. But if the question had said, how much should the company borrow? It's $205,796. If the question has asked that, how much should the company invest? It is 298 euro. Because that's what they need to invest. This is what they need to borrow. But the net is interest plus the principal that they borrow, because this is the principal that they borrowed. And they need to pay interest. At what rate? That would be at dollar rate. Yeah, but borrowing rate. So what is the borrowing rate for dollar? This is borrowing rate in Europe, 4% and 6% in home country. So that's at 6% per annum. And for 3 months, we did it the last time, is 1.5%. So which means the interest expense is equals to 1.5% multiplied by 205,796. So if you multiply that, so that means we have interest expense of 3087. So which means the total payment is that 3087 plus 205,796. And that gives us a total of 208,883 dollars. So that is the total net dollar figure. And that is this guy. And that is it for money market edge. This type of money market edge is the most difficult money market edge you can have. If it was to be a receipt, it will be easier because you are receiving foreign currency assets. All you need to do is just borrow foreign currency liability and they will match up. And that calculation will be much easier. But please always follow this process. Don't look for shortcuts. This is the way to simplify it for you, understand it and practice with it, and you should be fine. Yeah, I think I have a video on my channel that actually even create a short table for you, for whether you have a receipt or you have a payment for money market edge, and it's still based on this same method that I used here, which is the first thing is you want to know the company's situation. Yeah, when you know the company situation, it's either its assets or its liability. That's it. That's the situation you want to know. Then the next thing you want to do is to create opposite. So if they have asset, you create liability. If they have liability, you create asset. Yeah, but like about 4 steps you need to follow here. And like I said, if you look at that money market edge video, you will see the very short steps, very easy, straightforward, and it's the same approach that I've used here, which you can easily follow. Yeah. But most importantly, the first thing is know the situation of the company and try and create an opposite. Simple.